Why is understanding CapEx crucial for startup financial models? Imagine trying to build a house without knowing how much the bricks, wood, or labor will cost. That's what managing a startup without understanding capital expenditures is like. Capital expenditures are the money spent on buying, upgrading, or maintaining long-term assets like property, equipment, or technology. These are investments that help your business grow over time. Unlike daily expenses such as paying staff or utility bills, capital expenditures are larger, less frequent, and often more strategic. Knowing how much you will spend on these big items is key when creating your financial projections. For example, if you plan to buy manufacturing equipment that costs $50,000 and lasts 10 years, you need to spread that cost out over time through depreciation. This affects your profit and loss statements, making your financial picture clearer. When you include these costs properly, it shows investors that you understand your long-term investments and how they impact your business's health. CapEx also shows up on your balance sheet as assets. If you buy a building or new computers, those are added to your assets and depreciated over their useful life. This means your assets grow, but your expenses don't hit your income statement all at once. Instead, depreciation spreads the cost over several years, giving a more accurate view of your profitability. Cash flow is another area impacted by capital expenditures. When you spend money on big purchases, it appears as a cash outflow in the investing activities section of your cash flow statement. Planning for these large outflows helps you avoid running out of cash unexpectedly. For startups, especially those in industries like manufacturing or technology, forecasting these costs accurately is vital. It helps you stay on top of your cash needs and avoid surprises that could slow down your growth. In business planning, understanding CapEx helps you decide when to make investments. For example, if you plan to upgrade your software or buy new machinery, knowing the costs and timing allows you to align these investments with your growth targets. It also helps you prioritize spending on projects that will give you the best return on investment. Including CapEx in your financial models shows a clear picture of your company's future. It helps you plan your cash requirements, evaluate the return on your investments, and communicate your strategy to potential investors. When you understand your capital expenditures, you can balance spending wisely with your growth ambitions, making your business plan more realistic and achievable. This understanding is a foundation for making smart decisions during your startup's conception and planning phases, setting you up for sustainable success.